Welcome to Wall Street Confidential. Our focus turns to currency. Now, Jim, currency is really killing some strong international companies out there. What do you say about that?
Well, I mean, the Journal had a good piece today about it, and I think that what you really want to do, I mean, you know, sometimes there's just companies that really understand this, and it's better to listen to the companies talk about it than it is to try to figure out how it works. And Procter & Gamble, in its last conference call, spent a considerable amount of time talking specifically about the way currency has impacted their business. And the first thing you need to know is they said, and it's always disturbing when they say this, but there were it blew through 3 levels of deviation of what they thought it could happen. So, I mean, as is so many of the cases here, there's a lot of companies that model what will happen. And they'll model that maybe the dollar could rise 4 or 5%. And boom, it rises 20%. So all of their models are off. That's why they say 3 standards. It'd be like they're looking for, they know how to deal 5%, they don't know how to deal 15%. And so the impact of the currency is so great that it will look like they're not doing well. And what they urge you to do is recognize that they source in a weak currency, which therefore has to pay more for whatever it's sourcing, like oil. And then they sell in a weak currency, which then is translated back to a strong currency, the dollar. So it's a double whammy. And people just think, okay, look, I see the euro's up X, down X versus the dollar, and I can therefore compute their earnings. And you can't, because you have to recognize that the local sourcing in a lot of these situations is a second level of decline. So here's the bottom line on this. You'll look at a Kellogg or a Procter, and you'll say, okay, look, they look cheap. But you must be ready for another hit because of the local currency that is beyond the translation. Because right now everybody just translates, but they don't realize that the numbers that they saw previously involved a currency that wasn't weak buying raw goods, and a currency that was weak that they translated to. So let's say you think that currency should cause Procter a 4-cent hit. It may be an 8-cent hit. So, and again, I don't want to sell Procter. I own a fractionalistplus.com. I am just saying that the notion of stability in this market must also include a factor which says, when I see the numbers, they could be much worse than I expect, but it's because of currency, not because of top-line growth, which is the positive. Top-line growth is still there.
So should investors look to domestic companies then to
Well,
lose
I mean,
less,
I've been saying Altria is a domestic company, and Unilever is a company that is going to get a beneficiary of a translation. And General Mills is still largely domestic, but you know, you'll get a kind of a conundrum. Like this morning in the Journal say that Pepsi got hurt by the currency. That's not really true. Pepsi got hurt because of top line weakness, much less currency. But if Pepsi, if the media is going to presume that it was currency, it's only going to get much worse for the companies that are really international, much more than Pepsi.
All right, thanks so much, Jim.
Okay.
All right, so to learn more about how to trade with Cramer for a free trial, email us at action@thestreet.com.